There are, of course, plenty of stocks out there, but that doesn't mean that most of them are good options to buy. Today, we're going to be looking at 3 growth stocks specifically that have performed well because they're growth stocks, but also are not crazy expensive and have a good chance to continue to perform well. The first one we're looking at is KLA. KLA, you may or may not know what they do. They're a large company at 101 billion, but it's not like they're a household name. They are a key component in the semiconductor industry. They do a lot of supply to TSM. If you've heard of TSM, they're much larger. They're over $1 trillion company, and TSM provides resources to NVIDIA. TSM is what NVIDIA needs to make their AI GPUs. I'm not going to get in the nitty gritty of it, but it's a long supply chain where a lot of people are making money from it, obviously NVIDIA the most, but it's still a very, very important supply chain. That we can see 5 years, 318%. You don't see that every day. Most companies will probably never grow 318% 5 years unless they just started up. We can see if we're looking at the 10-year time frame. So we're looking at late 2014, early 2015, which, yes, was that long ago. We were at 65. So this is a company that's done crazy, crazy well over the last decade. It really has performed well. And on top of that, you have a dividend as well. So this is a company that's done incredibly well. They're in the tech space. The PE is only 35. That is not that expensive. The Ford PE is 25. So if we're going off the S&P 500 Ford PE, which is about 23, 24, you're only slightly more expensive than the S&P 500 for a company that has performed way better. The S&P 500 is only up about 100% over the last 5 years or so. So this is a company that has blown the S&P 500 out of the water by many multiples on the last 5 years, over the last 10 years, and the PE is cheaper, and it's in a very important industry. So this is one of the better companies that I would want to put my money in. And the only reason I don't have my money in them right now is I own a lot of semiconductor stocks and I only have so much money. If you gave me like $100,000 right now, I would definitely put some money in KLA. So Uber is another decent play. I don't think ride sharing, this sort of business, is going to go away anytime soon. So some of the positives, let's go that first. 94% of the last 5 years, you're about performing the S&P 500. If we zoom out, obviously they haven't been around forever. That's roughly how long they've been around as well. They IPO'd a little bit before in 2019. This is a company that's done fine. So obviously we want to do better than fine, but I think they have a decent chance to cut margins down as self-driving continues to ramp up and up. This is a company that isn't small, $141 billion market cap. They aren't a small company. They're profitable, 33 PE. Take a little bit of a look at that Ford PE, 26. So this is a company slightly above the S&P 500 valuations, but it's really pretty reasonable, and I think it's well positioned. It hasn't run up a crazy amount recently either, so you're kind of off all-time highs a little bit. All-time highs were around 87, so you're below that pretty significantly as well. However, and like I said, I think Uber can do well in the long term, and I don't think this is an expensive bet to make. Now, if I was to play a little bit contrarian, there is some competition in it. You might be worried about Tesla just absolutely blowing it out of the water and then just defuncting something like Uber. I don't think that's going to happen. I think Uber is going to be able to adapt and take advantage of upcoming technology. But if you were really worried about that, it could be something. Also, margins are just kind of tight in this business, and there is some competition as well. So all those things aside, I think Uber is a decent play long term. I don't know if it's going to be one of the top performing companies, but I think there's definitely worse companies out there. And I think Uber is like I said, we're off all-time highs. It's a decent price. It's a decent option right now. And then lastly, we're looking at Walmart. You may say, Walmart, growth stock, that's a value stock. Well, normally you would think so. You think retail, that's more value. You think of lower PEs, not as fast growth. Well, we look at Walmart. We're sitting at 38 PE right now, and we're sitting at growth 137%. And if we zoom out, I'm happy this website does not crash, because sometimes when you zoom out this far it does. We're at 25 in 2015. So S&P 500 up about 200% since 2015-ish, maybe give or take a little bit. We're doing better than that. We're kind of in that range, but we've done well. We've done well over the last decade or so. And this is a company that has done well. It's one of the better retail performers. Everyone knows Walmart. I think just in general, when you think of Walmart, it's going to perform well. It is, and they've taken a lot, especially when you look at competitors, something like Target. Target's kind of getting crushed right now. It seems like Walmart's kind of stolen some of those customers since COVID. Since inflation's been bad, some people went from Target to Walmart and they really never went back. So although this maybe isn't crazy impressive, when you look at the broader landscape that is retail outside of like maybe a Costco and then maybe some more specialty smaller stores, Walmart's doing better than most are. Dollar Tree's kind of getting crushed, Target's kind of getting crushed, so you're very optimistic that Walmart's been able to prevail. But if you're investing in Walmart, this is a growth stock. That's how it's valued, that's how it's grown. This is a growth stock. So if that's what you're looking for in retail, you could go with this one. You could also go with Costco if you're looking smaller. You could go Sprouts. I think these are all decent investments. But Walmart is not a value play, even though it is retail. I would look to something like Kroger if you're looking for something like that. But we can see Ford PE 33, so you do have a premium compared to the S&P 500, which is at about 24, like I mentioned. And then your PE is normal, it's at 38 right now. So like I said, this is a company that's valued above the S&P 500. It's not a particularly cheap stock, but it's Walmart. It's gonna do well. It just is. It's done well. It's one of the larger retail chains, not the large. I mean, look at that, $738 billion in market cap. So Walmart is going to be around, and they've done pretty well transitioning to online retail as well. They've done pretty well there. So I think Walmart is going to continue to do well in the future. I don't know if it's going to outperform the S&P 500, so I'd be slightly hesitant at these levels of PE, but there's plenty worse stocks to buy. Trust me, there are. So anyways, I appreciate all of you for watching this video. If you enjoyed, I'd appreciate if you like and subscribe. I do daily stock content on this channel. I appreciate all of you for watching, and I'll catch you next time.